Hi, I'm Tom Benet, President and Chief Executive Officer of the National Restaurant Association. While the current circumstances preclude us from meeting in person, the work the financial, tax, and audit community undertakes each day is critical for the business health of the restaurant industry. I'm glad you have chosen to meet remotely during this time. Welcome to the Tax, Finance, and Audit Expert Exchange virtual event. We're excited to share the latest and most relevant information essential to your daily work and long-term career. Whether you need guidance on tax changes, controlling the cost of health benefits, or structuring franchise financing, this virtual event is a real-time opportunity to learn about best practices from fellow restaurant industry leaders. This event will include an overview of the latest restaurant relief programs from Congress and a detailed research-based look at the restaurant industry's road to recovery. I know many of us have missed restaurants, dining out with friends and loved ones, joyously celebrating student graduations, toasting newlyweds, and sharing the simple pleasures of great food and captivating conversations. Much of this was lost for the past 5 months. We all want to get back to what we had, a thriving restaurant community. COVID-19 has fundamentally changed the business and financial operations of restaurants, from updates to payroll taxes to the evolving benefits landscape. The ingenuity of this finance, tax, and audit group is vital to the recovery of jobs, boosting revenue, and improving morale. Thank you for your hard work and tireless efforts to keep our industry in business.
Our first session of the day, Restaurant Industry's Road to Recovery, a data overview, is being presented by Hudson Reilly. Hudson is the Senior Vice President of the Research and Knowledge Group at the National Restaurant Association. This session will focus on the restaurant industry's evolving recovery by using our latest data and information. As a reminder, if you have questions, please put them in the Q&A box for Hudson to answer at the end of his presentation. At the conclusion of Hudson's presentation, we will move to a 15-minute break. Hudson, thank you again so much for joining us. The floor is yours.
Good day, everyone. I will start screen sharing now. Okay. Okay, hopefully everybody gets the full screen PowerPoint at this. On behalf of the National Restaurant Association's research group, it's a pleasure to have some time today to talk to you about the current state of the restaurant industry, and perhaps most importantly, where we see it heading the remainder of this year into 2021. My presentation is currently constructed, has 3 distinct components. First, we'll look at the underlying economy in the pandemic environment, historically, as well as going forward the remainder of this year, and most importantly, looking into 2021. And then we'll look how industry has performed against that economic backdrop, and then finally have the wrap up. Before I actually get started though, it's important to review the association's official definition of what constitutes the restaurant industry, which is all meals, snacks, alcohol prepared away from home, including all takeout meals and beverages. And it is the latter part of that statement, which we refer to as the off-premises market, which is takeout, delivery, drive-through, curbside, food trucks, and even catering. It is that off-premises component, which was primarily driving industry growth before the onset of the pandemic and has only become more important since the pandemic has progressed. So, for example, if you're to look at all restaurant industry traffic at the beginning of this year, about 63% of all restaurant traffic was off premises even then. If you fast forward to the second quarter of 2020, that proportion had jumped to 90%. 90% of all restaurant traffic was off premises. So obviously that will not be sustained as the pandemic comes under control and reopenings progress. But for restaurant operators across all of the segments, it really has become a very important operational characteristic. Also, too, when I talk about the restaurant industry, I'm not talking about this monolithic entity. For example, these are just 10 of the almost 70 segments that we look at sales in. So for example, full service where there's wait staff present tends to be more socialization driven. Quick service where in general there's no wait staff present tends to be much more convenience driven. But there's also managed services contractors at a host of different sites, academia, transportation, healthcare. Also, there's food service cited in, for example, in the retail host and gas stations and convenience stores. And then also the fastest growing eating and drinking place segment pre-pandemic, which is also progressing well, is the snack and non-alcoholic beverage bars. And as a consumer, you would know that, for example, as a Starbucks or Baskin Robbins. So thinking about the US economic backdrop, we now want to conduct our first polling question. So how would you describe the current state of the US's national economy? Choose one of the four: excellent, good, fair, or poor.
Okay, Hudson, we're just waiting on a few more people to respond.
Okay. Will you report it out, or is that?
I will share the results as
Okay.
soon as we're going to give a few more seconds for the rest of the folks to respond.
Okay.
Please remember, everyone, you need to respond to the poll questions in order to be eligible for your CPE credit. Okay. Let's go. Share results.
Okay, so basically it looks like 84% ranked as fair to poor and 16% as excellent and good. So you can see from the national survey, that's pretty much in line with what all the different demographic cohorts say. It's roughly now only about 1 out of 4 operators, consumers actually think that the economy is in good or excellent condition. Conversely, 3 out of 4 think that it's poor to fair. And you can see really up and through January, that was the highest proportion of respondents that said good to excellent. And then in June, when the reclosing started, the proportion that was weaker increased. And then conversely in September, as there has been more gradual reopenings, you can see that's moved up a little. But it is still amazing to think that in this environment that roughly the vast majority of consumers are pessimistic about the economy, because that obviously impacts their willingness to spend in retail situations such as restaurants. So one measure to look at economic growth is the old standard, real GDP. And the real just means inflation adjusted GDP, dollar value of goods and services produced in the national economy. And you can see that for this year, we are actually forecasting real GDP to decline by well over 4%. Now, this is the obviously weakest annual economic performance since the right after the post-World War II period. Looking ahead to next year, we're looking for some regain, ideally about 3.5%. But you'll notice that even in 2021, there is not enough growth to basically take the GDP level, which was achieved pre-pandemic, and reach it. That will not occur until 2022. So there are various ways to look at GDP. This looks at it on a quarterly basis. So, you start there in the middle of the chart, the last quarter of 19. Then the first quarter this year was down due to the substantial March decline. And then when the bottom fell out in the second quarter, almost 32% annualized decline. This quarter, we're looking for, in and of itself, what would be portrayed as a, exponential rebound, almost 27%. But if you look at what happens in the fourth quarter, still, there is no way that this economy goes back to the capacity pre-pandemic until well into 2022. Now, there obviously is a lot of talk about stimulus packages, which will help, but this is a sustained pullout from this trench. And it's important to remember that even before the pandemic, that the historical average for GDP growth had been weakening over time. This just looks at average annual GDP growth across different time periods. So you can see up until the turn of the century, it wasn't unusual to get annualized returns, the 3%, then it moderates after the turn of the century. Then comes the Great Recession there in 07 to 09. Then the decade out of that, right? The decade to get us to where we were pre-pandemic, just 2.3%. Then the drop this year. Then looking at a somewhat higher annualized rebound in the early 2023 period. But if you look at continuing that over the next decade, it is still quite a modest growth rate. Now, on one hand, that is positive because it's growth, but it isn't growth which has been achieved historically. And so when we're talking to operators, we always emphasize how important it is to gauge your results against the current economic backdrop against which your operation is performing. So if one has a legacy operation that's been going for a couple decades, the growth rates back then are obviously going to be higher than will be achievable now in most circumstances. And it really was time for a recession. That's sad to say, but if you look there on the bottom, starting back in the recovery from the Great Recession, June 2009, 128 months of consecutive economic expansion. So that is the longest expansionary period in US history. You can see it beat the one from early 1990s to just after the turn of the century there by a full 8 months. But the thinking was pre-pandemic that there would be a gradual deceleration, a relatively low trough recession, and then a pretty vibrant recovery. But obviously that has all been rewritten now. So from the restaurant industry's perspective, one of the most important macroeconomic indicators to track is what goes on with employment. And so going back to the Great Recession, if you look at what occurred between February 2008 and February 2020, this was the situation on a state-by-state basis regarding employment growth. So amazingly enough, even over that 12-year period, there were still 3 states that had fewer employees than they did before the onset of the Great Recession. And there were certain states, the yellow states, that over that 12-year period had virtually any employment growth. Now, the states in the green and blue obviously had fairly substantial employment growth. So employment growth drives income growth, which drives restaurant industry sales growth. And it's a situation where operators always need to know what the underlying economy is in their trading area, because the performance can vary dramatically just based on the underlying economy. So for example, areas that tend to have higher population growth, tend to have higher employment growth and hence higher income growth and therefore higher restaurant sales growth. So this was the situation in February. Now fast forward to August, and you'll see that going against that baseline employment back when the Great Recession was starting, the vast majority of states now have fewer jobs than they did 12 years ago. Yellow states, a little better, and the best states there are still shown in the green and blue colors. So it is an environment where, depending upon obviously the geographic location, even within certain states, operators have entirely different challenges. And so when you look at consumer confidence, which is basically the willingness of consumers to spend currently and make long-term financial commitments, it is primarily driven by what goes on with employment. So not surprisingly, in August, consumer confidence fell to a 6-year low. Now the number that came out yesterday basically moves that line now up to about the 100 threshold. But you'll notice that confidence going into the pandemic era was well above the 125 mark. So it varies dramatically, not only by geographic regions, but also among ages of the consumers. And currently, the weakest consumer confidence is in the youngest age groups, and the higher levels of consumer confidence are allied with the older cohorts. So looking at terms of labor recovery next year, you'll notice the quite obviously 6% drop there this year. And we're looking for some recovery next year, but short of any major stimulus measure, it will not reach the levels of growth over the past decade. So as a result, income growth is also moderated because the employment isn't there to be generating it. If you look at the total job loss for the US economy in this pandemic, at its peak, it was well over 22 million jobs. And the majority of that occurring in that April timeframe. And then you'll notice the gradual build out, it peaking in June, and then it's still positive, but not quite as positive as one would hope considering the circumstances. So there is definitely a moderation in national employment growth, and hence the importance of the association's work on the Hill regarding getting the stimulus and the employment support there to get the national economy having the ability to not only generate and maintain job base, but also the allied incomes. And one of the most important developments for the country over the past decade relating to employment relates to where that employment growth occurred. So if you look at city areas, they're on the left versus rural areas, between 2013 and 2019 on an average annual growth basis, employment was almost 2% a year in cities. Conversely, about half of that out in rural areas. So it's not surprisingly now that with all this development of restaurant establishments, particularly independent operations in many of these major metropolitan areas, that these geographic locations are being disproportionately negatively influenced by the hit in employment growth in city areas. So as I mentioned earlier, income growth without stimulus is going to fall back dramatically next year. So this year, you'll notice this is real DPI, basically just looking at inflation adjusted disposable means after tax. And do keep in mind that income is more—
Folks, I think Hudson's having some—
Hello? Can you hear me?
Yep, we can hear you.
Okay, all right. The income growth this year looks great at 4.4%, but don't forget that includes all of the stimulus money. And also income is more than just salaries and wages, it's dividend income, interest income, and transfer payments. So looking at 2021, you can see that that drops by a substantial 5%. Now that will change dependent upon what the federal and state governments do. But at this point in time, the income growth next year is not particularly in a positive situation. And it's important to understand with income where consumers spend it traditionally. Over half of all consumer spending is on housing or transportation. Just 13% is on both grocery stores and restaurants. 13% of all their spend, and restaurants pre-pandemic captured about half of that. Also, certain categories are rapidly expanding. For example, insurance. When you look at the CPI for health insurance over the past year, it's up 17%. So there are all of these other different competing concerns for not only food dollars. And it is interesting when we talk to restaurant operators over the years, we emphasize how important it is for them to not be aware of competing for that food dollar spend against other industries. You know, historically, most of the operators would consider competition to be other operators. But now it's important for the operator community to constantly remind consumers to spend in the restaurant industry, because obviously a lot of these expense categories are dramatically rising. Now, one positive aspect has been this year has been what's been going on with gas prices. Obviously, the miles traveled are down dramatically. Demand has dropped. And you look at the projections for regular gasoline, they're in the low 2. That's actually the lowest price since 2004. So diesel is somewhat higher, and that's more important to the supply chain community. But the fact is, because restaurant spending is basically a cash credit on hand endeavor, these lower gasoline prices are advantageous for the operator community. Working against that, though, is what's gone on with consumer debt. So if you look at the total US debt balance now, not surprisingly, those orange bars are mortgage debt. So that constitutes about 2/3. But now the second highest level is student debt, which is in that red area, and that continues to grow. It's now 11%, and is even higher than the auto loan burden too. So from an employer standpoint, from an employee standpoint, there are operators that are recognizing that this is an impediment, not only to industry growth, but also the ability for certain individuals to get in a situation that they don't have these monthly commitments against their incomes. Also, too, in terms of domestic travel and tourism, we look at 3 different components of that: business, leisure, and international visitation. If you look at restaurant spending traditionally, roughly about 1 out of every 4 restaurant sales dollars was travel and tourism related. That's a high proportion. And so when you look at not only what's gone on with business, leisure, and international visitation patterns this year, but once again, looking into 2021, there is a rebound, but certainly nowhere near to the levels that it was pre-pandemic. And the international visitation drop-off really does dramatically impact certain geographic areas which are heavily dependent upon these international visitors, just because they spend so much of their dollars on restaurant spend when they're coming from abroad. So moving on to looking at the industry performance against this backdrop, when we survey restaurant operators, as we have well for over 15 years now on a monthly basis, and ask them what their top challenge is, not surprisingly, the latest survey shows that roughly 7 out of 10 said coronavirus. You'll notice that 11% still say recruitment and retention. In general, outside of recessionary periods, recruitment and retention is the top operator challenge. But that obviously is no longer true. And looking ahead years, undoubtedly recruitment and retention will reemerge as a top challenge. But for the moment, particularly for certain segments of the industry, dealing with the lack of consumer demand and spend is substantial. So at the beginning of this year, if you looked at the association's forecast for total restaurant industry sales, we were looking at an $899 billion level. Currently, we're looking for a shortage of $240 billion over this period. That represents a 27% drop. And if you go against the 2019 base, that's a 24% drop. So, and this is on average. And obviously there are operators out there that are having double or even more of declines, and the number of closures and the temporary closures obviously results as this level of consumer demand remains substantially depressed. So now it's time for our second polling question of, when you're thinking about all of the spending on food in America today, what proportion of US food spending do you think is currently now allocated to restaurants?
Okay, Hudson, we've got about half the respondents, so we'll give it another few seconds. We're just looking for a few more of you. There's about 20 of you who haven't responded. Please do so to get credit. Okay.
Okay. Well, this is interesting because basically, when you look at the responses, it's an environment where most people remember the proportion of the food dollar from before the onset of the pandemic. So at that point, over half, 51%, of all spending on food in America was allocated towards restaurants. Currently, that has dropped to 45%. So it is better than it was in the second quarter. A couple of those months, it was in the high 30%. So it is an environment where we're still at least 6 percentage points below where we wanted to be. So here, this basically, when you look at the share of the food dollar allocated towards restaurants, it is better than it was. But the fact is, each one of those percentage points represents tens of billions of dollars in revenue, which is not being captured by the industry. It is in a situation that obviously the industry has put a lot of effort into dealing with the situation, particularly looking at new innovative techniques. But the fact is, when you consider the on-site dining experiences, they are getting somewhat better, but there's no way in this environment that that regain can be achieved in such a short time period. So this graph just looks at eating and drinking place sales, which is about 70% of the industry on a monthly basis. And you notice it starts way back in 2005, and there's the gradual build out of the Great Recession, and the gaps between the lines get larger. And then you can see where 2020 started up there, the black line in the upper left. Then the rapid descension down to a level lower than where the industry was 15 years ago. Then the gradual build out to where we are in August, and we're still at 2016 levels. In other words, there's at least another 4+ years of lost ground to be regained. So the trend is positive, so that's okay. But if you'll notice, the slope of the lines has been moderating as employment growth reflects that moderation also. So it certainly is not a V-shaped recovery for the industry. At this point, it looks like it's going to be more of a swoosh type recovery where you have that rapid drop and then the slow gradual build out. So for many weeks now on a regular weekly basis, the association has been surveying consumers about how they are using restaurants both on premises and off premises. And this chart looks at the different meal periods by consumer utilization over the past week. And so when you start at the left-hand side there with the dark blue line, you can see that, you know, over 60% of US consumers reported dining on site for dinner. Then that plummets there in the April-May timeframe, and there has been a gradual build out. And just earlier this week, when we examined the results from the past weekend, the dinner meal had moved up to the high 30% range. It was actually at its highest level since the onset of the pandemic. So the trend is better as there are more spaces opening up, even on a limited basis. But you can see that you're talking easily 23 percentage points to get back to where the industry was for dinner. And the same situation's obviously true for lunch and breakfast. Now we'll flip and look at the off-premises lines. And the dinner meal, not surprisingly, still has trended up from where it was in the beginning there in March. And the same is true. And breakfast has been holding its own. So the availability of these additional off-premises services has been critical in the industry's ability to mitigate even more downward pressure. So each month, the association produces what we call the Restaurant Performance Index, which is based on surveys of hundreds of restaurant operators. We ask them about their current operating conditions, as well as their expectations for the future. And you can see once again, the rapid drop there in the springtime, and then the gradual build out. And just yesterday, we released the August data, and that line moved up another 0.5%. So once again, the trend is directionally correct, but the levels still indicate substantial contraction and challenges ahead. And it's interesting to look at restaurant operator sentiment too. Just like consumer confidence is measured, we measure restaurant operator confidence. And the blue bars represent the proportion of operators that expected better conditions 6 months out. So you can see in April, there was this flurry of optimism that ran through June, and then the reclosing started. Then the optimism faded, and the worst conditions, a higher proportion expect worse conditions in 6 months, which are those higher yellow bars there to the right. In terms of them looking at sales expectations 6 months out, it really is a tale of two cities. For example, if you look at the three left-hand bar groupings, that's table service. And so if you fine dining, family dining, casual dining, very, very high levels of operators expecting lower sales in 6 months. Conversely, if you look at the two right grouping bar charts, The yellow, higher sales in 6 months, more optimism among the quick service operators, just because that segment has been so convenience driven for so long, and operationally and physically, they were set up to expand that off-premises market rapidly. In terms of capital spending, as you would expect, both historically and looking going forward, the January to March average was pretty typical of the operating environment for equipment. But as you would expect, because the restaurant industry is so large and there's such a huge economic multiplier impact of the industry, the equipment orders, the expansion and remodeling being put on hold. You can see in August that once again, the back off is there. So the restaurant supply chain really is in the same situation as the industry itself. It is interesting to note that there were a lot of stories and operator comments about how the industry had become overstored in the past couple years. And, you know, those observations were on target. If you look at the number of restaurants per capita through the end of last year, it was at a record high. But it's also important to keep in mind that the share of shifting to the spend towards the restaurant community continued. So the number of locations that could be put online and maintain a viable margin, the environment was such that they could. But now, which we were talking about earlier in terms of closings, not surprisingly, when you ask consumers, do they know of a restaurant in their community that's permanently closed? Well, in city areas, 2 out of 3 know one. And then if you look over on the right-hand side, still 44%, but basically a lower proportion compared to the 56% of all US adults. So thinking back about what the slides you saw about national employment, restaurant industry employment follows that pattern pretty darn closely. In other words, just in April alone, a loss of over 5.4 million jobs on top of 600,000 the month before. And then for, you know, the May, June timeframe, 1.5 million added each month. Then comes the reclosings, and that employment growth has slowed dramatically. And that's why a stimulus bill is so important from the association standpoint, as well as the industry's employment. Because if you look at the different segments, it's dramatically different in terms of how the drop was and the regain. So table service obviously had the largest drop through July, 3.6 million positions. It's regained almost 2.4, but well over 1 million positions are still not available in table service. It's still net negative in quick service. And you can see how across the different segments, the drops and rebounds have occurred. And so this brings into focus a very important component of restaurant operations, which has been how industry's productivity has progressed and how it varies by different segments. So one measure of productivity is just to look at sales per employee. So last year, the average restaurant sales per employee were just $64,000. You can see that's dramatically lower than other retail operations. And certain capital intensive industries will have sales per employee of $2-3 million per employee or even higher. So the industry has always been an extremely labor intensive industry. That's been one of its hallmarks. But in this environment where sales are so dampened, it is basically a situation where technology does come more front and center. So if you look at technology in the industry and what consumers think of technology in the industry, it's time for another polling question as to what percent of consumers do you think say there isn't enough technology currently being used in restaurants?
Okay, we've got about 3/4 of the folks who have answered. We'll wait a few more seconds and let some more respond. Folks, please be sure to respond to the poll if you're looking to get your credits. Okay.
Okay, the correct answer is actually 36%, which was indicated by roughly about 1 out of 3 individuals. So in this environment, technology adaptation has been accelerated. If you think about how consumers use technology in restaurants, we look at it in 3 primary areas: front of the house, back of the house, and through the smartphone. And in terms of consumers thinking there's too much technology, just 15%. So the research is pretty clear that consumers are willing, particularly substantially among younger cohorts, to use technology in their restaurant experience as long as it facilitates their service experience. So what do they consider restaurant technology and how are they using it? It's pretty darn pedestrian. They're just looking at menus online. They're looking up hours, directions, locations, some reviews, but more importantly, particularly in the pandemic, is the online ordering. It's interesting, if you look at digital orders in the restaurant industry pre-pandemic, of all orders in the industry before COVID started, just 1 out of 20 was digital. That has jumped and is now 1 out of every 5 orders is digital. So this has become a very, very important mechanism by which operators can position themselves competitively and also in terms of meeting consumers' wants and demands for a touchless experience. And so looking at mobile payments, this is just one example of contactless. Even before the pandemic, roughly 1 out of 5 American adults had already paid using a mobile platform, 1 out of 3 Gen Z. And so this has become another tool in the operator's tool belt whereby they can use existing technologies, either developed in-house or out of house, to facilitate the mobile ordering and mobile payment. The other issue which has arisen recently is sustained menu price inflation. There is one bright spot here, though, is that really for the first time since 2011, grocery store price inflation is outpacing that of menu price inflation. You notice there for a couple years, 2016, 2017, food prices on a wholesale level were down, so grocery store price inflation was actually deflationary. The industry, mainly due to rising labor costs, continued to post menu price increases of 2 to 3% a year. But finally, in this pandemic environment, grocery stores' pricing parity has increased. So from the consumer perspective, the price paid for value received is a little better now than it was pre-pandemic, but running against that is the lack of income growth and their decision to actually spend that dollar in food service. And so looking at wholesale food prices this year, you can see through August, it's rising almost 2%. And deflationary there for 3 years out of the past 6. And you know, once again, a restaurant operator's menu theme depends and dictates how their operational cost path progresses. So for example, you can take certain commodity groups, even though that says 1.9%, for example, eggs, beef, pork, are up by double digits year to date. And other commodity groups such as fresh vegetables, lobsters, and butter are down by double digits. So there has been a fair amount of menu re-engineering, not only simplification, but also re-engineering to align what's going on in the commodity pricing markets as well. So speaking about food, now we're just going to quickly review the highlights of a major association study, which has been done annually, the What's Hot Culinary Forecast. It's a survey where we worked with the American Culinary Federation, survey over 600 plus chefs, give them a list of over 130 different food and beverage trends. And we asked them, you know, among that list, what do they consider to be hot and what's not? So for the final and fourth polling question, what do you think is the top 2020 food and beverage trend in restaurants according to the latest NRA Chef Survey?
Okay, we've got a little over half who have responded. We'll give it another 10 or 15 seconds. Close call here, Hudson. I'll share the results in just a second.
It's the toughest one of the group.
Okay, last chance for you all to respond. Okay.
Okay, the correct answer is actually number one, eco-friendly packaging. If you look at the top 5 ranked trends for this year, the top one, for all intents and purposes, is sustainability. And even in the pandemic environment, particularly among younger consumers, the focus on off-premises packaging is front and center. Plant-based proteins also quite strong. And then you'll notice number 3 and 4, and that's what we refer to as the portability component. Menu items that are delivery friendly, that the product integrity is maintained, as well as the usefulness of having cuisines that are available in bowls. So the top 3 trends overall for this year are basically sustainability, plant-based proteins, and portability. And we also looked at different alcoholic beverages. And these were the top 5 that came out as the top rank for being hot this year. Most importantly, and particularly in this pandemic, is the greater availability of operators to deliver alcohol with those traditionally only food orders that are off premises. There are many states that have changed their alcohol beverage laws to allow this to occur. Some states are making them permanent. It is probably the biggest change to alcohol beverage laws in the United States since the end of Prohibition. So Certain operators have really tagged onto this opportunity. There's a rapidly growing market in single-use containers. So it is at this point obviously a more important lifeline to table service operators, but there are now even quick service and fast casual operators that are investigating and rolling out an alcoholic beverage platform to go with these food orders. And as restaurant operators, you know that we're looking at margins of different menu items and different beverages. Alcohol beverages definitely do disproportionately help grow revenue. So also looking at another landmark study the industry released at the turn of the year, Restaurant Industry 2030, where we convened a panel of experts and gave them a couple surveys that asked them to, in essence, vote on what they saw as the trends which would be important to the industry over the upcoming decade. And then what they do is they're different iterations of the survey where eventually consensus is reached. So these are the top developments that the operator community saw occurring for the industry in 2030. Not surprisingly, what constitutes a restaurant was changing and is now even more rapidly changing. And you know, that's been one of the defining characteristics of this pandemic environment for the industry, is that the pandemic has actually accelerated many of the underlying trends in the industry because of the need to, in essence, branch out from the traditional revenue streams. So restaurant definition really is more now in terms of points of access, the rapid development and proliferation of virtual ghost kitchens, the sharing of kitchens. The off-premises opportunities are only going to continue to develop faster. And you've seen that by the proportion of off-premises traffic in second quarter, 90%. So many of these operational developments which have taken hold will have the endurance to prevail even when the industry returns to a better posture to get that restaurant consumer dollar. So margin pressures, you know, even pre-pandemic, the margin pressures were there, just 4 to 6% of sales on a pre-tax basis. In many instances, the income statements of restaurants have been dramatically re-engineered. The margins are different, the cost structure is different. But the fact is, if you look at the cost structures for many operators in this pandemic environment, the cost pressures have only increased with some of the PPE spending, the higher food prices, the different labor distributions and needs. So even though margins are historically small compared to other industries, the operator community is really diligently being innovative on how to bring additional revenue streams and help the margin. Data is king. I mean, basically that means, you know, good business decisions have always been based on good data. And the data now, the ability of artificial intelligence to look at that data, to use that data to do predictive ordering, to do menu pricing in a real-time basis, dependent upon demand, dependent upon inventories, and the ability to manage back of the house pricing and stockpiling to dovetail with consumer demand. Over the next decade, it really does filter down to a much smaller operational level. And finally, the demographics of the consumers are certainly changing, as well as the demographics of restaurant employees. And that just continues the increased diversity and the increased aging of America continues well over the next decade. In terms of the 2030 disruptors, in many ways, the disruptors are opportunities. Obviously, the intelligent restaurant, which we were talking about, the use of artificial intelligence to drive additional demand, to market and connect with new patrons. Virtual restaurants and cloud kitchens. This is probably the most important development for the industry over the long term in terms of getting additional points of access. And it's a situation that some operators are being very inventive, creating separate brands. Some are focusing on their signature products. But the fact is, from the consumer perspective, in addition to, the reason they like off-premises so much is basically the restaurant coming to them, they look for additional points of access. In terms of the smartphone and apps, whether the apps are developed by the operator community or whether they're developed by third party, the important thing is to understand how the different demographics use those apps. It's interesting, the characteristics of obviously the younger versus the older cohorts in terms of how they use apps to order and the integration of loyalty systems with those apps. But younger consumers tend to order more by menu item than they do specifically brands or specific operations, which is different than the older cohorts. Autonomous vehicles we're developing and being used in select metropolitan areas. This is just basically using robot delivery vehicles for the off-premises markets. And then finally, a long-term important development is the ability, which was getting established pre-pandemic and has only become stronger, of many of these tech streamers are bundling food orders with many of these streaming services. And that makes perfect sense to make it a seamless experience from the consumer perspective. So to wrap up, looking ahead towards the next decade, this just looks at population growth across the United States by state. You'll notice that the red states over a 12-year period have less than a 2% population growth rate. So obviously maintaining and growing sales in those markets is an entirely different situation than being in some of those green and blue states. Even before the pandemic, consumers were cocooning more at home, watching on-demand streaming services than they were. And notice the highest proportion there is among the millennial and Gen Xer segments. Also, it is not critical not to underestimate the importance of having a loyalty program with the restaurant ordering systems. The expectations of many consumers is that they ultimately somehow deserve to be rewarded for being a loyal customer. And particularly with the smartphone now, these rewards are virtually instantaneous. I mean, you remember 10 years ago when you used to get the paper punch card and you keep counting down how many holes there were still remaining. But now it's all done in real time. And particularly with the greater integration of digital ordering, the loyalty systems really do become more important. Looking at the macroeconomic outlook going forward, real GDP positive next year, but still doesn't recover the levels that were lost pre-pandemic. DPI, short of major stimulus, we see contraction in income. Inflation will pick up, particularly with the Fed's easing of their inflationary targets. And US employment, somewhat positive, but also you'll notice nowhere does it recover the loss sustained this year. So to wrap up, this year is obviously the strongest year of industry contraction on history. The geographic variations are substantial. And so operator understanding these disruptive trends, but in many ways opportunistic trends of the pandemic, the underlying economics, the changing demographics, the new food interest, and the integration of technology. And so for the industry and the national economy, weakness and uncertainty continues well into next year. The industry will continue a greater emphasis on the off-premises market, the delivery, carry-out, and alcohol venues. Also, the value-added products, which is the operator community working in tandem with the supply chain community to move some of that labor off the site, off the pad, and back down the supply chain, and the much heavier reliance on digital ordering. So the consumers in an environment of tight income really do manage their total spend. So the ability to use many of these new technologies to nudge and incent the consumer into that decision to patronize a specific operation really is much more important. And technology, while it isn't a panacea to every operator challenge, it really does offer distinct competitive advantages. So that concludes my presentation, and thank you for your attention.
So Hudson, we had a question come in that I'm going to let you respond to.
Sure.
Joe said yesterday it was reported that one of the largest U.S. companies, Darden, announced they don't see the value in virtual concepts, saying it wasn't the right approach for them. Do you have any thoughts on that?
Well, being a trade association official, I can't comment on a specific brand, but I think it's important to understand the extreme diversity and fragmentation of the restaurant industry, and the operating plans and the inherent strategic decisions made to differentiate oneself from the competition are very unique. And so, I mean, you take an industry that even, at $659 billion is 70 segments playing against all of these different various geographic locations and sightings, which can vary dramatically. And so it's not surprising that there will be food service companies that decide not to go down this venue. I mean, you can look at any operating characteristic of a restaurant: is alcohol service, wait staff, menu. They are all competitive differentiators. And the fact is, there will not be a monolithic industry decision about how to proceed in this environment. If anything, for such a fragmented industry, the operating environment has even become much more fragmented under the pandemic circumstances, just because each geographic area has its own inherent underlying economy. And so, in this situation, the black swan was the pandemic, which inherently quick service operators and operators that had experiences in the off-premises market and were capitalized and ready to move quickly on some of those off-premises options had inherent advantages versus operations that were inherently staffed towards traditional table service. But the fact is, when you look at the peaks and valleys of the restaurant industry over the past decades, each circumstance is different and can aid or not benefit certain type operations. And in a way, it is this inherent diversity which gives the industry its overall resilience. And yes, $240 billion loss is staggering, but the consumer is still spending $660 billion a year. And it is the economic multiplier of that. The typical restaurant industry sales dollar generates an additional $2 in economic activity. So the economic impact, even in the worst case scenario for the industry, is still strong. And recent association consumer research about consumers' pent-up demand for restaurant services remains extremely elevated, particularly in the table service segment. Pre-pandemic was roughly 45% of consumers said they weren't using restaurants as much as they liked in their daily lifestyle. That jumped up to 80% in the second quarter. It's now down for table service to about 70%. So there is substantial pent-up demand. The industry is fortunate. The consumer wants to use it, wants to spend in it. They just have to overcome these barriers. And so looking forward over the next 10 years, we're fortunate it's an industry the consumer wants to spend in. And that's one of the inherent strengths. And, you hear many of these grocery store CEOs heralding that the consumer isn't going to go back to restaurants. Well, I say, let's talk in a couple of years, because I detect cooking fatigue has set in rapidly. And once the consumer feels safe and secure, the operations are going to be there to meet that demand, and the industry will once again continue on its upward trajectory.
Terrific. Thank you so much, Hudson. Some terrific information. We're now going to go ahead, folks, and head into our break. Looks like just about a 15-minute break. To attend the next session, be sure to refer to the agenda for the link to the 12:30 session, Managing Through Uncertainty. We'll see you then. Bye-bye.